It's 3:17 a.m. Your screen is dark. Your broker app is closed. You're asleep. And yet, the market just moved. Not a glitch, not a rumor, not someone in another country clicking buy. Price changed. Silently, with no human watching it happen. That's the uncomfortable truth most people never question. Markets move even when no one is trading. And once you understand why, you'll never look at price the same way again. Because right now, more of the market moves when you're not involved than when you are. This matters today more than ever. Liquidity is thinner. Algorithms are faster. Information travels instantly, but decisions don't. So price often reacts to things that haven't happened yet, or already happened hours ago, or were never real to begin with. Let's slow this down. Imagine a small town with one grocery store. If no one is inside, no one's buying apples. But the owner can still change the price. Why? Because the price isn't set by shoppers. It's set by expectations. If the owner hears a storm is coming tomorrow, apples might run out. So tonight, with an empty store, the price goes up. No trade happened, no apple moved, but the price did. Markets work the same way, just with better suits and worse sleep. Most people are taught a simple story. Price moves because buyers and sellers trade. That's not wrong, it's just incomplete. Because between trades, the market is still doing math. Here's the part rarely explained. Markets don't move tick by tick because of trades. They move because of quotes. Every moment, market makers are posting prices they're willing to buy and sell at. Those prices change constantly, even if nobody accepts them. Think of it like a used car lot. You walk by at night, no customers, no sales. But the owner still changes the sticker price anyway. Why? Because demand might change tomorrow. Because inventory might become risky. Because holding that car has a cost. Markets are full of those sticker prices. When a quote changes, price moves. A trade doesn't have to happen. Now let's go one layer deeper. Why would someone change their quote if no one is trading? Risk. Market makers don't want to be heroes. They want to survive. They hold inventory. That inventory can lose value while they're holding it. So they constantly ask one question. If someone hits my price right now, will I regret it? If the answer starts leaning toward yes, the quote moves. Sometimes aggressively. This is why price can jump in the middle of the night. Not because someone bought, but because someone didn't want to be forced to sell later. And this gets more interesting when volume drops. Low volume doesn't mean nothing is happening. It means every quote matters more. When fewer participants are around, each market maker carries more risk alone. So they widen spreads, they pull liquidity, they move prices preemptively. Ironically, quiet markets are often the most unstable. It's like an empty highway with one car swerving. There's no traffic jam, but one wrong move matters more. Now add algorithms. Not the scary sci-fi version, the boring accounting version. Algorithms don't wait for trades. They respond to probabilities. They scan order books. They watch volatility. They measure how fast quotes are changing. If something feels off, they adjust. Again, no trade required. Price moves because the math changed. This is why you sometimes see price drift for hours, then suddenly jump on no news. There was news. It just wasn't on Twitter. It was in balance sheets, in funding costs, in options exposure quietly rolling off. Which brings us to one of the most misunderstood forces in markets: options. Options don't trade much compared to stocks, but they control how dealers hedge. When dealers sell options, they inherit risk. They neutralize that risk by buying or selling the underlying asset. That hedging happens automatically, continuously. So when price moves a little, dealers adjust hedges. Those adjustments move price more, which forces more adjustments. A feedback loop. All without a single retail trader clicking anything. This is how markets can move on a Sunday night, or during lunch hours, or during holidays. Price isn't reacting to people, it's reacting to exposure. Here's the irony. The more efficient markets become, the less human they look. We built systems to reduce friction. Now price reacts faster than understanding, which leads to one of the strangest experiences in trading. You see a move, you search for the reason, you find nothing. Because the cause wasn't a headline. It was a risk limit being hit, a model updating, a quote being pulled. This is also why news often feels late. Price moves before the explanation appears. Then analysts reverse engineer a story. It moved because of inflation expectations. Maybe a dealer just didn't want to hold inventory into a funding window. The story comes after. The move comes first. And that's uncomfortable, because it breaks the comforting idea that markets are always rational, or even always reactive. Sometimes they're anticipatory, sometimes defensive, sometimes just cautious, and sometimes, honestly, a little absurd. Now zoom out. What does this mean for you? It means the market is not waiting for your opinion. It's not waiting for confirmation. And it's definitely not waiting for volume to come in before adjusting risk. Price is a negotiation happening constantly, even in silence. So when you see a sudden move and think, who did that? The answer is often, no one. At least not in the way you imagine. It was a system protecting itself. Which leads to a final uncomfortable thought. If markets can move without trades, if price can change without participation, then how much of what we call price discovery is actually risk management? And if that's true, are we trading markets? Or are we just observing the shadow they cast while managing themselves? That question doesn't have a clean answer. And the market isn't in a hurry to give you one.
Enjoyed this video? Like, subscribe, and hit the bell to level up your money game with Monetary Mentor.